Hi, I'm Jeff Bermet, and along with Nick Davis, we are the managers of the Libero Nexus Dynamic Solutions and Cautious Portfolios. April was a month that we will long remember in terms of volatility in the markets. We spoke to you last on the morning that Trump designated Liberation Day when he announced his set of reciprocal tariffs on almost all of the U.S.'s trading partners. The scale of the tariffs was much, much larger than anyone expected. The markets rightly reacted with massive panic. Equity markets sold off about 10% globally. And not only did equity markets sell off, but longer maturity U.S. Treasuries saw their yields rise. Within the next week, Trump walked back the implementation of the tariffs. And I think clearly the advisors within his administration that he listens to told him that what he was doing had so upset the financial markets that it was at risk of throwing the U.S. into recession. And since retreating on tariff implementation, we have seen equity markets recover, and we are essentially back to where we were before he made those announcements. However, he is still coming up with new announcements. He says he's going to put a 100% tariff on foreign films that are shown in the US, and how that's going to be calculated and implemented, no one really knows. And I think that is symbolic of the chaotic policymaking in the Trump administration. There's a lot of inconsistencies and holes in his economic program, and I am certain we will have more periods of turbulence similar to April, maybe hopefully not as bad as April, but as long as he's on this path of using tariffs to reduce the U.S. trade deficit and bring manufacturing back to the U.S., it's going to cause problems in the markets. Trump also promised to reduce government interference in the economy, and he set up the Department of Government Efficiency with Elon Musk, and there's growing questions about how that is working. And he also promised tax cuts, and those are still being discussed between the Republican-controlled House and the Republican-controlled Senate. They have wide differences on what kind of spending cuts need to take place in order to fund additional tax cuts, and there's a lot of wrangling happening there, and I would say nothing is going to happen until probably August on that front. So we're not going to get any immediate boost or relief from tax benefits. We are stuck with the tariffs and the threat of tariffs and all the noise around that as the driving policy force in the U.S. It's why we continue to hold less U.S. dollar investments than we've held in some time in the portfolio. We think it is safer to be outside the U.S., and I'll have Nick touch on the areas and the markets that we like and the opportunities that we see in the rest of the world.
So Jeff has talked about the wider outlook we've had over this month. April's been quite volatile. We've looked at this opportunity to readjust the portfolios, and where we've had funds come into the portfolio, we've had the ability to add to some of the positions where we saw some setbacks in stocks, particularly the European defence stocks, which have been very strong this year. Rheinmetall is up nearly 165% year to date, and we were able to add to one of our positions there in the dynamic portfolio. We look to be more defensive, not just in defensive stocks, but in areas such as utilities. So in the UK, we've added SSE, Scottish and South Eastern Water, and also a European MSCI tracker fund to give us a much broader exposure to that sector of the market. So the rationale for this is the increase in expenditure we expect in infrastructure from the changing budget allowances in Europe, where there's been more flexibility created. One, to allow the money to spend on defence, but also just a broader spending of cash to increase the economies. So as Jeff talked about the weakness in the dollar we've seen compared to the euro and indeed sterling. We had concerns about our positions in the American banks that we held. On the basis of this, we looked to reduce those positions, and in fact we exited entirely from most of the portfolios. Where we do see and continue to see value is in the European banks. So along with the Piraeus, the Greek bank we own, which has performed exceptionally well over this period, we added to Commerzbank and also to a broader European financials index tracker to the portfolios. We also added to the pharmaceutical exposure, and again that's been in Europe as well through a position in Sanofi. Again, so far these positions have performed well in a period of quite extreme volatility. A fact that's been quite in the news in the UK has been the cyber hacking of well-known names such as Harrods, Marks & Spencer's and indeed the Co-op. Our positions in the portfolio, we have a cybersecurity tracker, but also we have a position in Palo Alto, one of the largest providers of anti-hacking software. Also in our defence names in Europe, Thales and Leonardus also have similar sort of encryption services and providers which are for military but also for civilian use. One of the areas we've added to in the portfolios is gold, and this is in both solutions and in the cautious portfolios. Gold has had a fantastic run this year and looks continuing set to do so. We've reduced our exposure to oil in the portfolios as well. We maintained a position in BP as we had thoughts that this may be an undervalued stock that may attract some sort of bid at some point in the future. The rumours are that Shell is indeed looking to take over BP or acquire large parts of its business. This is a reflection of where there's a feel for global trends of how the economies are growing and a potential slowdown in growth as the tariffs bite. We've seen a ramp up in numbers over the last few months. A lot of this is down to where people think US companies have been buying in goods ahead of the tariffs coming into force to offset the increase they're going to see going through. And again, we've seen this reaction from companies like Airbus, who are looking to sell aircraft into the US and have said that any tariffs will need to be met by the customer. This is the wider impact of the tariffs and what we're seeing coming through. Whether these tariffs arrive in full, we wait and see. Depending on which way the wind blows depends on which way Mr. Trump sees the world and which tariffs he will impose.
So far, the data has shown, as Nick touched on, some front-loading attempts by businesses to import goods into the U.S. to be ahead of the tariffs, and consumers buying things in anticipation of tariffs raising the prices, so trying again to beat the tariffs. But that time's running out, and we are going to start to see price increases and probably shortages of goods as well. And how the public responds and how Trump responds to that is sort of up in the air. It's worth noting there are 7 lawsuits that are very well thought out, well funded by the plaintiffs, arguing that the trade authority that Trump is claiming he has because of a particular piece of legislation called the International Economic Emergency Powers Act, or IEPA, as the media likes to call it. And Trump is claiming, no, this act gives me authority to declare the entire past 70 years of U.S. trading history as an emergency that needs to be fixed. So it's very likely that the plaintiffs will win one or more of these cases in a U.S. District Court or the Court for International Trade, where these courts have been filed. Of course, Trump will then appeal, and this will go to the Supreme Court. So I imagine at some point this summer, we will have some very serious legal decisions that may or may not weigh very heavily on what Trump attempts to do. So I think the one thing that has been happening that Trump is probably, and the administration is happy about, is the decline in the dollar. A weaker dollar makes U.S. exports look more attractive to the rest of the world. So there may be something behind this, and we would expect to see more dollar weakness in the months ahead. And that's why we feel pretty comfortable continuing to hold less dollars than we have in the past.